Good afternoon and welcome to today's session of the Beginning Farmer and Rancher Lunchtime webinar series. As always, I want to acknowledge the support of the USDA and the National Institute of Food and Agriculture for their support of today's webinar session. We really appreciate you continuing to join us week after week on these sessions. In today's session, we'll be hearing from Alberto Gonzalez. Alberto is an Extension Area Agricultural Economist with OSU, and he'll be talking to us about how to use enterprise budgets as a tool for planning and decision-making with your operation. And I do see in the chat there that you request for reposting the link. I will certainly do that here in just a minute. Let's welcome Alberto, and please feel free to post questions as they come to mind, and we'll address those at the end. Thank you, Alberto.
Thank you for the introduction, Josh. Hello, everybody. I just want to know that if you have like some experience with budget, please just, or if you don't have, just let me know in the chat. And I'm going to share my PowerPoint. Just give me a minute. Okay, well, as you know, today I'm going to talk about the enterprise budgeting. And first, what is budgeting? Well, I will define or budget like a business plan that details all the components of a business statement, the cost, the revenues, profits associated with a specific business or a specific enterprise. That's important because I will say that it's a farm, or not farm, but it's a management tool that can provide invaluable knowledge. And for me, the knowledge is power, so you can have like a advantage among the competitors. So with this knowledge, you can improve your decision making, estimating profits, identify risk, identify areas of improvement, guiding resource allocations, and a lot of benefits. Okay, there are three types of budgets: whole farm budget, partial budget, and enterprise budget. The whole farm budget basically describe the characteristics, all the characteristics of a farm or a whole operation, identifying the component part and determining the relationships among the components. The partial budget, I would say that it's like a cost-benefit analysis, because in this budget you can measure the if there is a profit if you apply a change in an existing plan. For example, maybe you have 30 acres of wheat and some cattle. So you can harvest the wheat, harvest grain, and sell the cattle, or grazing the cattle in that on that field. So you can do a partial budget to see what option is better for you. And finally, the enterprise budget, that we are going to focus on this kind of budget today. That is a detailed financial statement that we can estimate costs, estimate production, estimate prices, and we can explore like different scenarios to see the possible profits, of if there is a profits or not. Well, just I want to recap with some financial terms that are important. Cost. When we talk about cost, we have to split into variable or operating cost and fixed cost. The variable cost, basically, there are the expenses of direct inputs correlated with the outcome or the production. For example, if you have cows and increase the herd, the direct cost is gonna increase. if the production decrease, the direct costs are going to decrease too. They are correlated. On the other hand, the fixed costs, they remain constant, and they are not related to the size of the production. I'm gonna give you some examples in a moment. Gross margin basically is the money or the return or the money that you have. I mean, if you have the revenues, you subtract the direct cost or variable cost, and that's the gross margin, the ability or the money to pay that variable cost. Then we have the net profit that basically is the total revenues, the difference of the between total revenues and the total cost. So basically, it's like if there is that indicator shows if the business is profitable or not. And finally, break-even point. I love this analysis. It's the point that says that if the revenues and the total expenses are the same. If you subtract the revenues and the total expenses, the result has to be zero. So this indicator allows us to see that in what price, or yeah, like in this point, or in this price, we can start earning money or losing money, and price or production. Now, the components. Well, in the picture, I don't know if you can see my click, but well, in the top part is the revenues concept. Like all the products that we can have here, that it's wheat, pasture, and other income, the price, the quantity, and then we can calculate the revenues. Then our cost. There are split in the operating cost or variable cost and fixed cost. Again, we have to be careful with the units. Units could be tricky to calculate the accurate costs. So we have the unit, price, quantity, and the price per acre. This is for wheat, so it's acre, but you can do it for bushels, for tons. So you can choose the unit. And well, also we have like all the returns above the operating cost, and the net profit, that is the returns above all the total costs. Now, here these slides mention the lack of information, but I'm gonna explain you in the next slide. There is another example. I understand better if I see like pictures or graphs. That's the reason I show this to you. This is of Calv Enterprise budget. You can find this budget in the OSU website. And well, this Calv Enterprise budget has more products: steels, heifer, cool cows, replacement, other income. And again, there are the units, the expected price, expected quantity, the revenues, the total revenues, and the revenues per head. And again, there are the multiple operating inputs with the units, price, quantity, and the fixed costs with the returns of above operating costs and total costs. Now, revenues. Well, revenues basically is the yield or outcome times prices or price plus additional income if it's the case. But we have to be really we have to be realistic in this when we calculate the yield or the and the prices, because we can't know the future. Okay, so for example, this is just there are just numbers, and we can lie to us. So we have to select real numbers. We can just increase the price here or the quantity and always obtain profits or positive profits. So this enterprise budget provide like facts, hard facts. Maybe we don't we are really we are eager to start a business, but the reality is like it's hard to do it. So how can we there is a risk, like we can base our budget in possible prices, but we can see just the markets today, the stock, the market is dynamic, and the fluctuation in the last weeks show us that the price can change just in hours. And the same with the outcome, especially in agriculture. There are weather conditions that could impact the crops or the health of the livestock, disease, pests. So the to get the revenues, we base on expectations, and there is a risk. So you have to be you have to know about that risk, and it's your choice how much risk do you want to take or not. So to calculate the expected outcomes, expected production, you can base on reliable technical information. That it's a really common mistake. Always use like the in the range of, for example, yield of corn. Use the highest um, use the highest yield because it's possible. So maybe take an average, or well, the point is use a reliable technical information, range of production outcomes. We have to see the production techniques. What because not all the farms are the same. Each farm has different resources and conditions. So you have to adjust your business plan to your resources. Also, I would suggest to use the yield benchmark of the county or of the state to determine the yield, and see if your product could have like additional income. Now for prices, there are a lot of institutions that can or publish their expectations. So it depends in what institution you trust or not. There are the future market that is a good base to market with average price that is published by USDA and other institutions. Uh, uh, I will suggest historical prices, but again, all of these have risks. So you have to be you have to know about that risk. Now, variable cost and fixed cost. In variable costs, we can find like seeds, planting materials, fertilizers, pesticide, medicines, full on maintenance, custom machinery, among others. And in fixed cost, usually there are the depreciation of the machinery and of the livestock. Then it's one of the largest costs. Loans, interest, insurance, taxes, if you rent the land, or mortgage. Now, I add some extra cost definitions. We are we won't focus on this in this course. However, I think that it's important to share with you. What are the overhead costs? Well, there are costs that are difficult to allocate because they are related to multiple um, enterprises in the whole operation. For example, the barn, or for example, if you have an employee who is the responsible of record keeping or budget. So he will work on different areas because usually a farm has different center of cost. Could be the farm that a cow farm and also has the hay production and grain production. And so there are like multiple center of crops in one farm. So the costs that are related in that multiple or that different areas, there are overheads. Now, depreciation. Depreciation is a gradual value decrease of an asset over a period of time due to multiple factors. And currently, for me, is the largest cost in the multiple budget that I have worked in the last weeks. And finally, there are opportunity costs. Opportunity cost is the value or economic value of the second best alternative that was rejected, or the benefit that you miss when you choose another choice. For example, if you are if you're gonna open the or start working on the farm and you hire from your or you have like another job offer, the opportunity cost of your salary is the salary that you are that you reject. And you can I mean, I just mentioned this because could be cost, or it's a cost that could be used in the salaries. Now, well, there are the formulas for the break-even point. The part of the left, the break-even point price, is that, for example, with the steers, with the price of 315, we have the variable cost and the total production. So if with 315, how many pounds we will have to cover the variable cost? And the same with the break-even point of production. If we are expected 40 bushels of wheat, this formula is gonna show you with the minimum or the price that we have that we will need to cover the variable cost, and it's the same with the total cost. And I'm gonna show you in the Excel in a moment if you don't if you didn't understand with this, but well, it's just a formula here. And as economist, I love to explain things with graphs. Well, the red line is the fixed cost. The yellow line, there are the variable cost, and the green line are the revenues. So in the intersection of the green line and yellow line, that is our break-even point. We don't have profit, or well, the profit is zero, because it's the exact amount to cover the total cost. So if we increase, for example, if we keep or remain the same price and increase the quantity, like the area between, or that triangle between yellow line and the green line are the profits that we can get. And the same with the other graph. I just change the slope of the revenues to show that price could be the difference, or quantity could be the difference. Oh, I add another one. Here is the same. I just mix the graphs, and with price one, we need like the quantity one to get to the break-even point. But if the price increase and we have price two, the break-even point is gonna move to the left. So is it the new break-even point is the intersection of the green line and the yellow line. And now I'm gonna open the Excel to show you. Can you see the my screen, the Excel?
Yes.
Perfect. Thank you. Okay. I just add two sheets in this Excel just to make it really easy for you.
Excuse me. Actually, we can't. We see the PowerPoint still.
Okay, let me see. I think you can now.
Yes.
Perfect. Well, this is Excel that I just shared with you. There are just two sheets here, one for info and the other for the budget. The budget is basically the same information that I show you in the slides. And if you want to explore different scenarios, just move the information in the first sheet. Yeah. I organize, or the structure of this sheet is first the revenue that I always try to explore different scenarios. So I put like several options for the production. In this case, is for wheat, bushels by acre, per acre. So it's the first one is just 28 bushels, 35 bushels, and 40 bushels. And the expected price, the base is the expectation of USDA, that is 5.5, and I just decreased $20 and increased $20, 20 cents, sorry. So here, if you want to explore more options, just change the values in these cells. This is for 400 acres, but you can, I mean, we are going to calculate the cost per acre. So this factor is not going to change a lot. Then are the costs. And again, I just split in the variable cost and then the fixed cost. Here are all the inputs that I consider need for the produced wheat. Are the seed, fertilizer, pesticide, management labor, custom harvest, fuel, lube, repair and maintenance of the machinery, crop insurance, other expenses, and the annual operating capital. Also, I add the option, if you own the combine, or if you custom the combine. So to explore that, or to see the difference in the cell before, you just have to change to custom. Well, okay, back to the information. So remember, we have to put like, we have to, the units have to match always. So there is the seed, unit, the price, the total price, and the price per the unit per bushel. Same with fertilizers. I mean, I just include prices, like local prices of Garfield County. For fertilizers, these prices are for Two Rivers Cope, and as I mentioned before, you have to use like official data or reliable data. So the I base the nutrition on the Oklahoma Soil Fertility Handbook. I just add like the yield goal and the pounds of nitrogen required per acre. So in this case, this you can explore different pounds in the cells in the I column. If you change 70 by 50, the pounds applied per acre of nitrogen will change. I just put all the, you can see all the formulas here if you wanted. So back to the normal thing. And also if you change like the yield goal, this estimation is gonna change too. And this is just like an indicator that you are that you need more fertilizer or not. And okay, you get the price per pound and the cost of all the fertilizer per acre. I do the same with pesticides. Use this pesticide doesn't mean that they are like mandatory to use for wheat, but I just wanted to add like more products for this exercise. And well, this part is more complex. Diesel consumption, use, and repairs and maintenance of the machinery. In this situation, and in this exercise, we have 2 tractors, and these are the equipment that we're gonna use. So there are the characteristics with what tractor they work, and the performance rate. So basically, this is the base to calculate the diesel, the cost of diesel per acre, the lieu, and the repair maintenance. I use these parameters, the cost of fuel and the cost of wage of the salary. You can change these two in these cells, and all the results are gonna change automatically. I'm gonna share you a PDF where I obtained this performance information because I didn't calculate by myself the repair and maintenance. I just based on this cost from this from that table, but I wanna share with you at the end of the session. And the same here with the combine. So you can calculate the again the diesel, lieu, and the repair cost for each equipment. Also, if you custom the harvest machinery, I just add the custom rates. I took them from OS2 extension. We have to update that, but it's just used as a base. And the point is that you understand like how calculate all of this process. Again, all the formulas are here. Basically, to calculate the diesel consumption for field cultivator is if field cultivator works with the tractor number one, we know the full consumption. So we are gonna multiply full consumption by the total hours per acre that we are gonna use the field cultivator times the cost of the full, and do the same with all the other equipment. The LUF is just the 15% of the diesel cost. And for the maintainers, we need I can share you the formula, but we need to get more factors, and sometimes it's tediously to calculate it, but I'm gonna show you the table that can give you the numbers, at least for the base. If you want to dive deeply, we can do it, but we're gonna have to collect more information. Well, again, the cost of insurance, the cost of miscellaneous, and now fixed cost. In this exercise, fixed costs, there are just depreciation, interest, and taxes and insurance. So again, we need to have a lot of information, and basically it's impossible to just give like fixed costs, like a general fixed cost, because all the farms are different, all the machinery is different. I mean, only if we have like the average of multiple farms, we can publish something like that. But these are like individual costs, because it will depend of the useful life, annual use hours, and the purchase price. So basically, the depreciation formula, there are a couple of methodologies, but the most common or most popular methodology is just the purchase price uh, minus salvage value uh, divided by the useful life. But there is another formula to get the salvage value, and I can give you all the formulas if you want it. However, to calculate this depreciation cost, I based on Excel file that is a template that can give you all that information. I'm gonna share with you at the end too. And then I just, I got the depreciation, the interest, and the tax insurance, and taxes and insurance costs. And then I just calculate the cost per hour and the cost per acre, because that template just provide or show the total cost. So let's explore the scenarios. Okay, we have like 3 different yield goals. The number one is for 28 bushels, and 3 different prices: low, middle, and high. So with the low price and the just 28 bushels, without other income, that in this case could be just rent the pasture for grazing, or hay, the bale the hay and just sell it. I don't know, I'm just sharing ideas. But there could be another income. But well, just with this income, the revenue is 148, and we see that red numbers, basically the total variable costs are higher than the revenues, and of course the um, net profit is going to be negative. Now, in this part, we have the break-even analysis. This one, or the first one in the left, is based on on the production, 28 bushels. So what is this number says? Say, if you harvest 28 bushels of wheat, you need to sell it at $6.86 to cover your variable costs and to cover or to pay all the total cost and don't earn money, but don't lose money, to more than $7 per bushel. And with keeping constant or lowest priced, that is $5.30, we have to harvest 36 bushels to cover the variable cost and more than 40 bushels to cover the total cost. So we can see like the different scenarios, the maximum quantity that I add here. Again, if you want to explore more options, you can just change these numbers. I choose this yield because I collect this data from the ag statistics from USDA. So with 40 bushels at the lowest price, again, the gross margin is negative, or the returns after variable cost are negative, and you can see the break-even point from all of this situation. Now, okay, this is custom, the equipment. We can see if we own the equipment and at least the returns above the variable cost are positive. However, when you own the equipment, the depreciation cost increase, and the returns above the total cost is not profitable. So we need like $5.82 to cover the total cost. And finally, let's see the best yield goal with the highest price. Almost we see the positive returns after variable cost, but negative returns above the total cost. And here again, we have the break even for production and for price. Does anyone has a doubt about this?
Yeah. Are you asking for questions, Alberto?
Okay, let me open the chat.
If anyone has questions, feel free to ask any specific questions you have about how to use some of the budgets. Does that conclude your presentation, Alberto?
No, I just trying
Okay.
to back to my PowerPoint here. Can you see the PowerPoint?
Yes.
Okay, so the sources for data to calculate the enterprise budget, the best source is your own records. If you don't keep a record, you should. Record keeping is the best source for your business analysis. If you don't do it, you can use like the summary analysis of the area, use the county production data. I'm gonna share you a link of Kansas State. They have a lot of crop budgets, farm budgets. Again, all the farms are different, but could could use like that values as base. Farm literature and information from meetings, especially if that meetings are in your counties or in your community, and neighbors. There are really good reference to. Again, we should don't try to emulate what they do, but at least for their yields, for the what they apply for prevent disease or for pest, because you shared like the same conditions. I mean, at least the same weather conditions, and probably soil conditions. Okay, they are the some examples. If you want to see like the prices for cattle, beefbasis.com is a really good source to do it. You can choose the location. In Oklahoma, there are 4 or 5 locations. Just choose the point closer than to you, and the different dates. Quick stats from USDA. They provide they offer a lot of information if you want historical revenues, historical yields, or historical prices. It's a really good resource. And finally, the important considerations. Oh, I missed it. But the enterprise budget or budget, there is not complete information. You expect a lot, or we have a lot of expectations, especially in outcome and prices. The best, so there is a risk. You have to be if you are the manager of the farm, you have to know about that risk. I mean, you don't have to bet all your resources just in that in one enterprise budget, because there is a risk. But I mean, it depends of your if you adverse the risk or not. Use reliable data sources to determine the quantity of input that you are gonna use or apply, and to determine your yields or prices. Remember that each farm is different, and the point of this management tool is that you can't use your resources in an effective way. Again, consider the price and marketing risk, and these consume a lot of time and could be tediously, but have a lot of advantages, and can give you even a good budget kind of offers a lot of advantage. And of course, you can, it for me is knowledge, and the knowledge to know, or you can know the whole process or all your process, and this can give you an advantage among the competitors and in the industry too. And that's all for me now. There are my contact information. Please feel free to contact me if you have any questions about budgets or anything related to ag econs, and also try to reach out the educators in your county.
Thank you, Alberto.